Sorry about that. Here we go. Good afternoon, everyone. This is Kathy Neifeld, one of the 4 partners at Agency One, together with Ed Lesher, Dennis Bartos, and Gonzalo Garcia. I am honored to welcome you to the 2020 Agency One Annual Advisor Conference. This is day 6.5 of the Annual Advisor Conference, and we still have 2 more weeks of phenomenal speakers and content to share with you. We hope that you have registered and will attend the upcoming sessions. Thank you for joining us. Earlier today, we heard from our phenomenal underwriting team led by Dennis Bartos and Jessica Karakoff, along with Chief Underwriter from Lincoln Financial, Jordan Carrera, and Nicole Myers from Swiss Re, on what is happening in underwriting currently in the COVID-19 environment, technology advancements and big data and how that's affecting underwriting, and lots of additional phenomenal information as it relates to underwriting in general. If you missed that session or any of the sessions from the last 2 weeks, they have all been recorded and are available to you on the CVent site through the attendee hub. This afternoon, we are honored to have with us, again for a bonus session, Ed Renn. Ed is a partner with the international law firm of Withers Bergman and is an internationally recognized expert in, among other things, estate and tax planning. Ed is going to provide an executive summary of his session from last week, Opportunities for Wealth Planning in the Face of Proposed Democratic Tax Policies, and also answer any questions you might have. This session is designed specifically for you to address any questions you have since you did not have the opportunity to ask any questions last week. Again, on behalf of Agency One, we apologize for that technology glitch. Just a couple housekeeping items before I turn this over to Ed. All attendees are in mute. We encourage you to submit questions through the chat function. And the session is recorded. There will be a link to the session made after, there'll be a link to the recording made after the session. And please do not forget to complete the session survey after the session. I want to thank you again for all being here. And now I am going to turn this over to Ed. Thanks, Ed.
Thank you, Kathy. I'm happy to be back and want to sort of summarize what we covered in about an hour last week and in a few minutes, and then open it up to any questions or observations that you all have. In a nutshell, I'd really say that Biden's proposals, the 4 big ones are: 1, changes to the income tax. What he's really talking about there is taking you from a 37% top marginal rate up to 39.6. But I think that's really the small item in the income tax proposals. Where that break to the top rate occurs is going to be $100,000 or $125,000 lower than it currently is. So that's going to affect a lot of people. And the real sort of scary thing in the income tax proposal is a reduction of the value of your deductions. Right now, if you're in the top bracket, it's a 37% bracket. If you pay $1 of mortgage interest or you pay $1 to a charity, that dollar comes off of your income, effectively saving you 37 cents by making that contribution, at least on the federal level. His proposal is to reduce the value of all deductions to 28%. So that effectively means that if you have given $1 to charity, you're still going to pay tax on a portion of that dollar because you're in the 39.6% bracket and he's only giving you a 28% deduction. That combined with the return to the P's limitations, where effectively we look at the amount of money you earn over a fixed level. The P's deduction before TCJA was in the 300,000s. We assume because Biden is making everything $400,000, that's where the P's deduction will go. You look at 3% of your income over that, you reduce your deductions overall by that number. You're guaranteed 20% of your deductions. That's your floor. He can't go below 20. But effectively, if you're a high earner and you don't have a lot of deductions, you're going to lose virtually 80% of your deductions in some scenarios. So what's that mean for you guys? Obviously, income tax going higher, deductions going lower, are going to look for ways to shelter income. And that combined with my next point, which is capital gains for most of your clients going to 43.4%, because it's going to go to the top marginal rate of 39.6. And you're still going to have the Obamacare tax for 3.8, so it's 43.4. Suddenly, an insurance wrapper, whether it's any kind of policy wrapper, is going to look very, very attractive to your clients. Even some annuity solutions, even though they're imperfect from an estate tax standpoint, might make a lot of sense from an income tax standpoint. So I think there's real opportunities for you there. The bad side on the income tax changes are many of your clients that have been doing like-kind exchanges are going to lose the ability to do that. And most of you are going to lose the 199A deduction because he's going to cap that at $400,000. So he's going to treat all businesses that were getting 199A, which effectively took the 37% capital gain rate and reduced it by 20%, making that 29.6 income. That's going to go away. By the time you get to $500,000, it's gone. It's going to be sort of eased out between $400,000 and $500,000 under his proposals. It will effectively raise the tax bill for most of your small business clients. It's also going to raise the tax bill for most of you. Capital gains, the big news is the idea that anybody making over $1 million is now going to pay at the top marginal rate. He's not making the net investment income tax or the Obamacare tax disappear. So effectively, that's 43.4%. If you're in a state with any kind of state income tax, you're looking at close to 50% on capital gains. Now, if you're in California, it's worse. The reality is a lot of clients are going to be, right now we're willing to say, look, capital gains, I've got losses, I can offset, it's a reasonable rate, I'm a buy and hold investor. When it starts to approach a 50% bracket, again, they're going to be looking for some solutions that avoid that immediate income tax, and you've got it. You've got the product. Life insurance will solve these problems for your clients. The third major thrust of the Biden proposal, which also there isn't much to do about, and it will impact most of you, is the idea that right now you pay the OASDI portion of Social Security, 6.2% to you, 6.2% to your employer. If you're self-employed, 12.4% to you on the first $137,700. That's going up to something like $142,000 next year. But by the way, what Biden wants to do is you won't pay tax between taxable wage base and $400,000, and then it'll kick back in. So all earned dollars at $400,000 and up will attract the 12.4% OASDI tax. The only solution here is if you can suddenly find a way to pay yourself some rent or pay for something that's not going to be subject to the payroll withholding taxes, that's going to be your way out. But realistically, if this happens, high earners, self-employed, are basically, forget all the other tax changes, they're going to lose 12.4% of their income simply from this change. The big one that you've probably been focusing on is, and the one that'll also probably significantly improve the insurance market for you, are the changes in the estate tax. He's talking about kicking rates from 40% up to 45%. That doesn't really move the needle very much. But he's also talking about taking the exemption down from 11.58 to $3.5 million. And that loss of over $8 million of exemption is going to cost each client north of $3 million. So it's sort of the time to plan is now. Realistically, we're within 3 weeks of the election. We're less than 100 days to Inauguration Day. We really do think that these tax rates can be made effective to January 1st. It's been done twice in 2 other presidencies. If we have Biden elected in a Democratic Senate, clients really need to get something done before the new year. I've also seen some proposals lately where they're going back to the Obama Green Book and they're saying, well, not only is he going to take the tax down to 3.5 on the estate side, but he may take it down to $1 million on the gift tax. I think that's people just looking at the playbook, and his playbook really are many of the Biden tax, the Obama tax proposals. But I haven't seen anything from Biden or from Camilla that basically suggests that they would do this. Now, Ms. Harris is also interesting because going on what she proposed when she was running for president, we could be looking at top marginal rates of 70%. She was in favor of a significantly higher income tax. And we be looking at estate tax brackets as high as 77%. So the idea that Ms. Harris might be more moderate than Mr. Biden, at least based on what she was discussing back in December, January, and February, probably not the case. Now, what's that really ultimately mean? What we're trying to do is get clients to do their wealth transfer now, use that $11.58 million of exemption or as much of it as they're comfortable using, get it into a trust vehicle, and in some cases, we're leveraging up from there. I mean, we've now got the money, let's buy an insurance policy because the insurance policy is going to provide the family with significantly enhanced benefits. I know what I forgot to mention. On the estate tax side, he's going to take away the step up in basis. And, you know, one of the nice things about an insurance policy is it's paid in dollars from their full basis assets as long as we hold it till death, in 98% of the cases. So there's no reason why clients should have any resistance to using trusts in conjunction with their insurance. If we have a grantor trust structure set up and mom and dad would otherwise be paying the income taxes, but there are no income taxes because we've got the investments primarily wrapped in insurance, or conversely, we need more death benefit because 11.58 didn't move the needle for this particular individual, and the family needs more money to keep the business intact on the death of the senior generation. The leverage that insurance is going to provide is huge. So you're going to be making, you know, sales that are intended to protect assets from income tax, investment sales, and you're going to be making estate planning sales where the client isn't so interested in keeping the money growing tax deferred. They're interested in the greatest benefit they can get for the dollar. And depending on the client, there's going to be a blend of assets there, blends of sale types. But realistically, I think it's pretty safe to expect that you will see an improved market for life insurance if, in fact, Biden is elected. I mean, at this point, if there's any questions or if anybody wants to make any comments, or you know, I don't really have a horse in the race as far as predicting who's going to win or not going to win. The latest numbers I saw suggested that Biden had come back a bit, but they were still saying there was a 65% probability that he would win. Someone pointed out to me yesterday that the numbers at this point in the campaign 4 years ago basically had Hillary in the same position that Biden's in, and somehow Trump pulled it off. We're not going to know until we know. One of the concerns we have is, you know, it's easy to say, well, we'll start planning on November 4th, but what if we have hanging Chad 2 like we did in 2000? Most of you look like you were around for that one. It took us 6 weeks to get that sorted. If I can't start planning until December 15th and it's got to be done by December 31st, that's going to be a tough one. So, I mean, clients really need to at least make sure they have a vehicle that they can make the gift to. They don't necessarily need to make the gift yet, but they need to know what they're going to gift and where they're going to gift it, and if we need to create discounts or we need to make controls so child A and not child B end up with the voting control of the family business, now is the time to do that.
Ed, can you hear me?
I can.
Okay. I tried to type this in the chat, but I wasn't able to send it. One thing that you have not brought up are tax rates for completed trust, completed irrevocable trust. For example, if an intentionally defective grantor trust, once the first generation passes away, do the rates not revert back to maximum tax rate at 39%, 38%, or at 13,000 of income?
Yeah, I mean that's absolutely fair. An irrevocable trust that's not grantor, a complex trust, it basically reaches the top of its bracket lower than $15,000, and it is a top bracket taxpayer in those scenarios. Again, a life insurance wrapper will work in that scenario, but realistically, the vast majority of my clients are top bracket taxpayers, however you cut it. So it's very hard to create a scenario where the tax rate is going to be less than top bracket. So for a lot of those clients, if they're already top bracket taxpayers when it's a grantor trust, the fact that it's going to go top bracket to complex trust, the opportunity to control rates there is to make distributions out to individuals who are perhaps in lower tax brackets if they can be trusted to do the right thing with the money.
Well, Ann and I happen to be working right now on the second of two family situations. The first one are 4 grandchildren with trusts that have been around since 1995, where now the second generation is gifting $30,000 a year. And we are now allocating that $30,000 into accumulation, index and universal life policies for the long-term tax efficiency. And right now have moved into a second family where there are 6 grandchildren, where all the contributions to the trust are being allocated, and the grandchildren are 16 to 24. So the grandparents are looking at the attractiveness of long-term accumulation, but they're also looking at the attractiveness of the opposite scenario, that it's going to take a number of years before these trusts really blossom fully as far as access for the grandchildren, because they want to limit the access to the grandchildren. So,
well, I mean, they could if they've got significant wealth and they're worried about losing their exemption, they could certainly make gifts between now and the year end. Depending on how the trusts are drafted, it's certainly possible to make a gift to a grandchild, and it could be decades, or in fact, the way I draft trusts, it could be their entire lifetime before they see a distribution. So it's possible with an absolute discretion standard drafted properly that the trustee, who you're giving a lot of power to, could decide who gets money and when.
Yeah, and there are individual trusts being set up for each of these 6 grandchildren, and trustees on one side is the mother, the grandmother on the other side. So that's exactly what we're doing.
Hey, Ed,
Yes.
are you popular with the subsequent generations, since your trusts are drafted in such a way that
you know,
never
I mean,
see any money?
There are families where we've actually done the transition from Gen 1 to Gen 2 quite successfully, but sometimes, no, it's a great point, Kathy. I mean, sometimes no matter how hard I try, I'm always going to be perceived as dad's lawyer. And, you know, in the Gen 2 or Gen 3 are going to want their own representation. I mean, that's fine. I mean, my duty is to my client. If I can retain the family and have another client on my client's passing, that's great. but the reality is I've got to do the right thing. And sometimes when they're told no, they can't build a floating racetrack in the Atlantic Ocean, they're not happy with me.
Well, in our situation with the children, the ages that they are, this is Gen 1 going to Gen 3, $250,000 into each trust. But the framework from grandma and grandpa to the grandkids is, okay, we're going to set this up for you. And you handling this and you being responsible is going to dictate about what we're going to do in the future. So it's a great teaching opportunity.
Yep. Yeah, that sounds right. I had a
hey Ed, for when you spoke last time, one of the things that kind of made me giggle a little bit at the end was your comment that this is the new proposed new administration and what's happening right now is a great opportunity for life insurance advisors, and how much you like working with life insurance advisors and appreciate the planning that does need to take place and the use of the terrific products that the life insurance advisors have available at their fingertips. One of the questions that came in was, in addition to a likelihood of new life insurance sales with a Biden win, do you foresee that also impacting the use of survivorship or second to die plans?
Yeah, because I think I think what happens under Biden is lots of our clients that over the last decade or so have outgrown the need for, the exemptions have grown so much, our clients have stopped needing estate planning. The doctors, the lawyers, the successful accountants, some of the small business owners, folks that back when the exemption was $600,000 or $1 million or $3.5 million, they needed some planning, but at $11.5 million, they don't need anything. There's exemption. More and more of those clients are going to come back and need an estate plan. And frankly, some of them are going to look at their lawyers and their accountants and say, hold it, I had a $3 million policy a decade ago, and you told me to not pay the $20,000 a year. I dropped it. Now the same policy is going to cost me significantly more, or I can't get it because of my health or whatever. I mean, there's going to be a return to a lot of those, $1 to $5 to $10 million policies that were being purchased to basically provide for estate tax liquidity. Survivorship works great for that because properly drafted, nobody's taking away the unlimited marital deduction. So you basically leave everything to your spouse, or you leave the exemption amount. He or she can access it. And then ultimately the estate tax reckoning comes on second death. The survivorship policy kicks in, and that'll work very nicely. So yeah, survivorship will be, will certainly have a place. It's not going to work. It's going to work just as well, and it's going to be used in more cases because there are going to be more cases. And for what I call the middle class millionaire plan, a survivorship policy is a little cheaper. Maybe it gets a little more coverage. And it does exactly what they want. It pays the tax so the kids don't have to sell the business or liquidate the stock portfolio.
Thank you. We've got a question about slats, but before we get to that, earlier on in your presentation, someone asked about your reference to the cap gain rate at 39.6%. And the question is the proposal for cap gain to be the same as ordinary income?
Yes. I mean, for folks making more than $1 million in a year. And what's not clear, and what I think is really kind of wrong about this, is take your client who's spent their whole lifetime building up a business, and now it's a $3 million, $5 million business. They go to sell it. Effectively, they've crossed that $1 million line. And so what that effectively means is, 43.4% on the federal level plus whatever state bite there is going to go off in taxes. And realistically, you've got lots of folks who have worked their whole lifetime to see half of it go to the government now on sale. That just doesn't seem right. The other thing is, think about it in terms of no step up in basis. Mom and dad bought a house in a suburb, in the 50s or the early 60s. They have a basis under $100,000 in the house. The house is a nice house, but it's nothing special, but it's on a 3-acre lot, and the neighborhood has gotten very, very desirable, and folks want to pay for it, so that $60,000 or $80,000 house is now $1 million house. When the kids inherit that house, they're not expecting to have to pay any tax. Mom and dad don't have an estate tax owed, and they're used to getting a step up in basis, but it's $1 million house.
Right.
When they go to sell that, it's likely to push them into that 39.6% capital gain rate, and effectively half of what they got from mom or dad is going to disappear in federal and state taxes. There may eventually be some drafting that happens that rate only kicks in at a certain level, or a step up in basis occurs for assets below a certain level. The Biden proposals are all over the place. They're not in a nice white paper or a nice policy statement on his website. They're really sprinkled in a dozen different parts of his webpage. And in some cases, there's no detail at all. They just tell you there's going to be a tax or a tax credit, depending on what he's trying to accomplish.
Thank you. All right, now let's move on to that question about slats. The question was, can you discuss the use of slats for clients that may be concerned about, quote, needing the money, end quote, later? Specifically, what are the key issues to make sure that you don't have a reciprocal trust, and how to best plan from an estate tax and a legacy standpoint?
Yeah, it's a great question. And we're doing a lot of this for clients right now, because one of my hurdles is I have clients that want to give away the $23 million, even if they barely have it. So part of it is keeping my clients from impoverishing themselves. You have to know when to say no. You can't give it away. Realistically, for folks in that $20 million up to $20 million, maybe they can give away one exemption amount. And the way to do it is don't gift split. Have one spouse exhaust their exemption and have the other spouse retain their exemption, so they have the $3.5 million. But what slats really are trusts that make the assets available to the surviving spouse and to the children. And the idea being, because it's not a marital trust, we need to use a state tax exemption on it. So if my wife and I were willing to give away $23 million, we'd each give away $11.5 million. My trust would be for the benefit of my wife, Barbara, and my 3 kids, and her trust would be for the benefit of me, Ed, and my 3 kids. We have the same 3 kids. And then we would have some differences in the trust, because your questioner's very, very smart. They're aware of reciprocal trust or mirror trust doctrine. And actually, when you look at the cases and you look at the private letter rulings, it doesn't take much to make the trusts non-reciprocal. But very often what we'll do is one spouse will have a limited power of appointment that the other spouse won't have. One trust will remain a pot trust until the death of one or both of the first generation, and then break into separate shares for the kids. The other one will break into separate shares when the kids reach a certain age. You may have a scenario where one spouse is going to include charities, the other doesn't include charities. There are little nuanced differences you make in the trust document, how you replace the trustee, the role of the protector. Cumulatively, you want the trust, when somebody that's really does this stuff looks at it, can say there's 6 or 8 differences that are of substance in the document. But as far as the client is concerned, they both do the same thing. They make the money available to the spouse, and they make the money available to the kids. But think about that. If I give away $11.5 million and my wife can get all of the $11.5 million if she needs it, and if she gives away $11.5 million and I can get all the $11.5 million if I need it, my trustees agree with me, realistically, we gave away $23 million, but if hell broke loose and we needed that $23 million, in theory, we could get it back. And that's sort of the charm of the spousal lifetime access trust, the idea that the spouse can get the money. Now, you run into a problem when the first spouse dies, they don't have access to 23 million anymore. They only have access to 11 and a half, and whatever it's grown to. But realistically, most of the time, these are provisions that we'll put in most trusts for people under 50 or $75 million. Once you start to hit $100 million, it's up to the client whether we're providing spousal access. Sometimes it's just cleaner not to. I mean, one of the downsides to spousal access trusts are because a spouse is a beneficiary, by definition, they're going to be a grantor trust. And sometimes you may not want that status.
So continuing on this spousal access trust topic, we were faced with this scenario last week, which kind of caused us all to go, huh? And it was a client who was talking about creating a slat with his wife and said in the planning meeting, well, what if we get divorced? And they had been married for, 30 some odd years, and there's $50 million that they're doing the planning for, and kind of caught us all off guard. And the question is, what do you do in those scenarios, and how do you account for that in the document, and what is the effect if there is a divorce?
You can either, there's a couple of things you can do, but ultimately it's a business decision for the client. In some scenarios, we just hardwire the spouse. I leave the money to Barbara and my 3 kids. She leaves the money to Ed and her 3 kids. And, it doesn't matter if she's my wife or not, that $11.5 million is there for her. But Withers has always been a big believer in something we call the floating spouse definition. So what we say is my spouse at that point in time. So today my spouse might be Barbara, tomorrow my spouse might be Jane, and in 5 years my spouse might be Alice, and whoever happens to be my spouse gets the benefit of that trust. Now, it's a little hard to do that when it's a couple that has earned their money together and they're each funding trusts for the other. The lawyer has to watch how they handle that from a legal ethics standpoint in terms of, explaining to both of them the significance of the floating spouse. But that's one of the ways to avoid it. But very often, I'm drafting a trust right now for a celebrity couple, and basically they're putting in a very expensive vacation home, and they've basically decided it's hardwired, come hell or high water. If we got divorced, I think she's the cute, more famous one, and her explanation was something along the lines of, well, it's in the Caribbean. I only need it December, January, February, and March. You can have it the other 8 months of the year. But it's a matter of just trying to figure out how you're going to structure these things. In a lot of these scenarios with longer marriages, where realistically they've either earned the money together, or worse yet, we're in a community property state, you're really going to have to just accept the fact that as much as you may now despise the person because you've gotten divorced, they're going to still benefit from this, and you're still going to benefit from their trust if they've done something along the lines of benefiting you and your kids.
Okay. And again, keeping on the theme of the slats, the next question was, can one be a trust for only the other spouse and the other for the spouse with dynastic provisions? Is that enough of a difference?
Well, yeah, but I mean, I suppose if it was, I wouldn't want it just to be for the spouse, because I don't need exemption to do that, typically. If we said it's going to be the spouse during his or her lifetime, and then it's going to drop down to the kids so that the only current beneficiary is the spouse, yes, and that would not be a mirror trust. That would not be a reciprocal trust. You would definitely, yeah, different beneficiaries gets you out. So sometimes you'll have people sprinkle in nieces and nephews, include their parents, include their siblings. If I've got a trust for my kids, my wife, and my siblings, and she has a trust for me, my kids, and her siblings, those are different trusts.
Thank you. If anybody has any other questions, please type them into the chat function, which is at the bottom of your screen. Those are all the questions we have right now. We can give this another minute or two. Ed is graciously here for you to answer these questions. I see the advisors that have dialed in are some of the best in the business. So they're certainly here to listen to you, but if any of them, this is your chance, guys, that if you've got anything on your mind, and we're going to keep it in the estate planning realm, Ed is happy to answer those questions. Gonzalo.
Yeah, hey, Kathy, I was just going to suggest, I mean, some people may not feel comfortable typing, and if they'd rather just take themselves off of mute or raise their hand as I did, and we'll just unmute them from our end.
Sure.
Please ask.
Yeah, that's fine.
You know, this is, Ed, I'm sure you don't mind that we get into a conversation.
Not at all.
Anybody? Bob, hold on. I just asked to unmute, Bob. There you go.
Am I unmuted?
Yeah.
Okay. Ed, last week in your presentation, one of the things that you brought up is Biden Harris are proposing either limitations or exterminating 1031 exchanges. Is there any word about attacking the tax-free accumulation of cash value inside life insurance policies?
No, you guys have the best lobbies in Washington. I know. I mean, I really.
Good to know.
I mean, you know, it's like it comes up from time to time. You know, there've been Green Book attacks aimed at PPLI, and you know that's a possibility, I suppose. But so far, no, nothing in anything they've said has impacts taxation of life insurance in any way. So, and you know, I would think if you took a poll, I would think that, you know, over 95% of the congressmen and senators all have life insurance policies. So I can't really imagine. It's sort of like the whole justification. Nobody thought the insurance trust would ever get attacked because they all had them. So I don't think they view those as aggressive, privileged planning. They just think it's something reasonable people do. But who knows? I mean, you know, anything, when you start drafting tax law, you never know what's going to sneak in. But I would be very, very surprised by that one.
This is an interesting question. It's something that I've often wondered myself, frankly, when I hear about business valuations and someone says, we got a good one. And I'm not really quite sure what a good one means, but we have an advisor who's asking Roy specifically, we have a situation where the business valuation seems to be considerably low. I guess he got a good one.
Mm-hmm.
What if is the likelihood or greater risk for that to be attacked?
Well, it depends on why the valuation is low, but I mean, the reality is, you know, before COVID, most closely held businesses would get discounts for minority interest and marketability of about 30 or 35%. And with COVID, because nobody has any stomach for risk anymore, you pay more, you pay less for riskier assets. So effectively, we've seen valuations go up to 45% for things that might have been 10 or 15 percentage points lower before. So it really is a time where you could see significant discounts. I think a lot of the real estate appraisers are taking into consideration that apartment buildings or landlords that haven't seen rent checks in 9 months before they're going to be able to actually evict anybody. Maybe strip malls aren't going to be as necessary. Shopping malls aren't going to be necessary. Office buildings are empty. I just think that, people are not going to pay up right away for those assets quite the same way they did before, and that's going to be reflected in the valuations. So depending on, who did the valuation, if it's one of the top-notch valuation firms in the country, you probably don't have, you always have the possibility of having a fight about valuation, but you can minimize it by using good appraisers. And the other thing, keep in mind, you can use defined value clauses, what we call laundry clauses, that say if your client intends to give away $11.5 million and it turns out that the government decides that that transfer was 15 million, he really only transferred 11.5. And there's more back in the kitty, or it's gone to a charity, or it depends on how you want to draft these things. But defined value clauses, if you think you've got a very high number, very high value asset, you've got a very low number, and you're worried about valuation attacks, using a laundry clause in conjunction with the planning can minimize some of that risk.
Right, because Roy did go on to say, as we're speaking, that in all likelihood, a sale is going to occur in about 6 months at a higher value. So they've got,
well, the more,
two
yeah,
different different metrics going on.
The more time that can take place between the transfer and the sale, obviously, the better off you're going to be. But, arguably in 6 months, if we've got a vaccine and the world is back to normal, that would explain why valuations have changed. If suddenly oil is worth twice what it's worth today, it would explain why a drilling company is taken off. There's, there are changes that do occur in 6 months. But you try to do the best you can with these kinds of things. And if you really think there's no basis in fact for the valuation, maybe you go back to the appraiser and you say to them, can you come in with something that's not quite so favorable because we're not comfortable with it.
Right. Okay, that makes sense. Again, I'm going to invite everybody to, that's all the questions that we have right now. Let's give this another minute or so, and we do have one more. So the comment is, so not only is it a great time to move assets from a political risk standpoint, but many business and other assets are depressed. Not to mention their owners.
Yeah.
Depressed.
And the other thing that you really have right now, guys, and I'm sure you recognize it, is you're at all-time, historic lows for interest rates, and a lot of estate planning is triggered off of interest rates. So if you've got 40 basis points for the 75-20 rate, any joker can beat a 40%, 40 basis point return on an annual basis, and as long as you do that, it's going to be successful planning. So ultimately that's something that sort of gets missed now, but things you should be talking to your clients about is if there are intra-family promissory notes, you should probably be refinancing them now, assuming mom and dad don't want the money. They want to give the money to the kids as cheaply as they can. There's something to be said for making loans and just basically taking back, a 30-year note right now is 1.12%. So, 1.12%. Most investment advisors can beat that rate of return. So that growth above that 1.12% is out of your estate and in the hands of your kids or your grandkids or a trust for their benefit. And it's a very, very nice way to shift some appreciation. There's things to do that don't require 50-page estate planning documents supported by, 87 different LLCs.
We also had a request for you to comment on gift and sale combinations in the current environment and what the opportunities are there.
Absolutely a fantastic opportunity, because you've got the $11.5 million exemption, and the rule is basically for every dollar you gift or every dollar the trust has in the grantor trust situation, you can turn around and sell another $9 worth of assets. So with discounting, I can take that $11 million and effectively put nearly $20 million of underlying assets in it if we're talking about a business or real estate. Thankfully, I guess, the discounts we saw in the publicly traded stocks that, were down in March by 30 or 40%, all of that has come back. So there's really not much of an opportunity there, except in certain sectors. I mean, you could argue that finance or energy is a sector that still has some depressed values in it. But generally, we're talking about closely held businesses and real estate. So you put in that gift of 11.5, and then you can sell another 90 to that trust. And because it's a grantor trust, it's not a taxable transaction. If I sell my child my business, I've got to pay capital gains tax. If I sell a grantor trust for my child my business and I'm the grantor, it's not a taxable event. Now, one of the downsides used to be your children don't get a step up in basis when you die because you sold them the asset and they took a carryover basis in a grantor trust transaction. That's true. It's still true. But if we enter the Biden world and nobody's getting a step up in basis, so what? So, realistically, we spend a lot of time with spreadsheets. These notes to pay back the $90 million of sale, they may be amortizing, they may be partially amortizing, they may be interest only. For really aggressive clients, occasionally the interest will accrue. It can be designed to do what your client wants it to do. And it really is a way to realistically, with a husband and wife right now, I think I can probably transfer $250 million and get it out. I mean, obviously, the note payment is going to be in mom and dad's estate as it comes in. But we've frozen the value of their estate, and all future appreciation should be occurring in a dynastic vehicle. So that's a home run. And all we need to do is allocate GST to the gift portion. The sale portion doesn't need the GST, which is, really, really important. I mean, people are beginning to finally really understand the power of GST planning. Obama did have a proposal to cap GST at 90 years. Biden hasn't resurrected it yet, but that's the Obama tax proposals seem to be his playbook. So if he gets elected, we'll have to see, but I think it'd be grandfathered.
Okay. You had mentioned previously the phenomenal AFR rates that are available right now, and a question had come in. An advisor has a client who would like to use today's long-term AFR rate for a loan split dollar program, but they want to pay the premiums over time. The question is there a way to fix the AFR rate by setting up a line of credit from the company to the trust to accomplish this? Or could they advance the trust all of the premiums and then have the trust loan the premiums back to the company?
I'd want to play with it a little bit before I gave you a final answer, but I think that's the right answer. I think you advance the money now and start the interest running and accruing and lock it in 30 years or whatever you want to do in terms of getting long-term AFR, and you go. But I mean, we used to always try to use midterm AFR because it was always a really compelling rate. Most of the time, most businesses you could get paid off in 9 years. Long-term AFR at 1.12% is going to look like one of the steals of the age in another decade or 20 years. And I think there's a lot of power to that planning, and our clients are generally going to be happy with us if we put them into those kinds of arrangements. So I think there's a little bit of interplay here between normal estate planning and the split dollar regs. I'd have to crack a couple of sections of the regulations before I'd want to put a Withersberg stamp on it, but it seems like it ought to be able to be done.
Thank you. And that leads right into our next question is, what are your views about split dollar plans? Some attorneys remain skeptical regarding the long-term efficacy, but my plans Hold on. But my plans from the 80s and 90s remain very viable. Your thoughts?
Yeah, I mean, I think it all depends on how they're structured and in how you dress them up. I think there's some risk in family split dollar. There was a case within the last year that was not particularly helpful, but it did throw some cold water on the planning. But I think there's a role for it. I think as long as the client understands the risk, we certainly do them for clients. I don't know that family split dollar is the first thing out of the toolbox, but it remains a reasonable option in the right situation.
Thank you. I do not see any other, oh, here we go. What are your thoughts about generational split dollar? We're going to continue on the split dollar path.
Yeah, I mean that's really the intra-family split dollar is
Right.
usually a generational play, and I mean I think it's I've got clients that have done it. I've done it for clients, and I've even given opinion letters on it. Though frankly, the opinion letters were before the court cases. So, I think it has a real attraction, and I think there's going to be, whether it's through the technical dynastic split dollar approach or something else, I think we're going to find Gen 1 and Gen 2 trying to make sure Gen 3 has adequate life insurance. And it's going to be back to the idea of, get that policy growing when you're young and the rates are down, because we need it to keep the wealth in the family. We need to keep the business in the family. And there will be different ways that it will be done, but it's going to be under Biden. It's going to be a lot like it was 20 or 25 years ago.
Thank you. And we're going to entertain one more question, Ed.
Mm-hmm.
You have been so gracious with your time. So as a follow-up, what about the Harbaugh, Michigan split dollar use for not-for-profits to avoid the 4861 issue?
That's it's not just Harbaugh, just about, a vast majority of the college coaches have these deals. I think there's, I've been told by my charitable guys that there are potential issues with some of them. But I haven't done one, but it's certainly, it's creative thinking. And I think it's quite doable, done right. I just think you have to just watch. It's the old, pigs get fat, hogs get slaughtered. I think there are ways to do these things that'll work. I think sometimes people try to keep too many controls, and you depending on who the split dollar is with, if it's with one of the foundations or the athletic supporting organizations, you can run into some issues on the charitable side. But yeah, I think I think you'll probably see more life insurance used for deferred comp across the board, because that tax-free buildup is going to be really important. I mean, Biden's talking about a 28% income tax rate instead of a 21% rate. He's talking about an additional 10% surcharge on products manufactured abroad, sold into the U.S. I mean, corporate rates are going to go back up again. So the idea of having assets that are exposed to tax are not going to be all that attractive. And you guys have the secret. You've got the tax-free wrapper.
Thank you. That's going to wrap it up for the questions. Ed, again, I cannot thank you enough for how generous and gracious you have been with your time and for your friendship to Agency One. This has been a phenomenal follow-up session. I want to remind everyone that the original content is recorded and is on the website. And also this session has been recorded. If you would like Ed's slides, please feel free to reach out to us and we have them. A few reminders, please remember to fill out your surveys. They will be emailed to you sometime later this afternoon. Also, I hope that everyone will join us next week for another jam-packed week of fabulous content. We have a number of sessions, and I am sure that something will apply to your practice. These sessions include an economic update on Tuesday with Bob Bauer, Chief Global Economist with Principal, a session on IUL products and the impact of the changes to AG 49 that are going to be implemented in November, a session on linked benefits, an update on the legislative landscape and the implications of the upcoming election and what this means to the financial services industry from the CEO of FinSeca, which, as you know, is formerly AALU. And again, we have our virtual exhibit hall, and we have even more sessions than I just rattled off. Please refer to the agenda, and we hope that you are going to join us next week. Again, thank you, Ed. Thank you, everyone, for your participation. We hope you have a safe and fun weekend, and if Agency One can be of any assistance, please reach out to myself, Gonzalo, Ed, or Dennis. Thank you so much. Take care.